Capital allocation is one of the most important and often underestimated aspects of investing. In 2026, markets are faster, more interconnected, and more sensitive to macroeconomic shifts than ever before. In this environment, success is not just about finding opportunities, but about how capital is distributed across them. This guide explores how professional investors approach capital allocation and why structure, discipline, and context matter more than ever. Capital allocation is the process of deciding where, when, and how much capital to deploy across different assets or strategies. It is not a one-time decision, but a continuous process that evolves with market conditions. Many beginner traders focus on individual trades. Professionals focus on portfolio structure. A strong portfolio is not built from isolated positions, but from how those positions interact with each other. In practice, capital allocation determines not only potential returns, but also the level of risk exposure. Traditional investing often relied on static allocation models, where portfolios were divided into fixed percentages across asset classes. In 2026, this approach is becoming less effective. Markets now react quickly to interest rate changes, inflation data, and global liquidity cycles. As a result, capital flows between sectors and asset classes more frequently. Professional investors increasingly adopt dynamic allocation, adjusting exposure based on current macro conditions rather than fixed rules. Diversification is a key principle of capital allocation, but it is often misunderstood. Holding multiple assets does not automatically reduce risk. True diversification comes from exposure to different types of risk, not simply owning more instruments. For example, assets that move in the same direction under similar conditions do not provide real diversification. Over-diversification can also lead to dilution, where the impact of strong positions is reduced by too many small or uncorrelated trades. The goal is balance, not maximum spread. Correlation plays a critical role in capital allocation. Assets that are positively correlated tend to move in the same direction, while negatively correlated assets may move in opposite directions. In modern markets, correlations can change depending on economic conditions. For example, during periods of high inflation, commodities and currencies may behave differently than equities. Professional investors monitor these relationships closely. Instead of viewing assets individually, they evaluate how positions interact within the overall portfolio. An important distinction in professional investing is the difference between allocating capital and allocating risk. Two positions with equal capital size may carry very different levels of risk. Volatile assets require smaller allocations, while more stable assets can support larger exposure. Professional strategies often focus on balancing risk across positions rather than simply dividing capital evenly. This approach creates a more stable portfolio structure over time. Capital allocation is heavily influenced by timing and macroeconomic context. Entering a position is not only about price levels, but also about the broader environment. For example, during periods of tightening monetary policy, investors may reduce exposure to risk assets and shift toward defensive sectors. In expansion phases, capital may flow back into growth-oriented assets. Understanding where the market stands within a broader cycle helps investors allocate capital more effectively. Liquidity affects both entry and exit decisions. In highly liquid markets, capital can be deployed and withdrawn efficiently. In less liquid environments, large positions may be harder to manage. Professional investors consider liquidity before allocating capital. They avoid overexposure to assets that may be difficult to exit under changing market conditions. Liquidity management becomes especially important during periods of high volatility. Capital allocation is not about making perfect decisions every time. It is about maintaining consistency over a series of decisions. Professional investors follow predefined rules for position sizing, risk exposure, and portfolio adjustments. This reduces emotional decision-making and improves long-term stability. Consistency often matters more than short-term performance. Capital allocation is the foundation of any sustainable investment strategy. In modern markets, where conditions change rapidly, disciplined allocation becomes the key to long-term success.